So tonight at 6 p.m. Eastern, silver futures decide to wake up after their weekend nap, reopening on Globex. There's a very particular pattern that if it shows up in the first 45 minutes, you absolutely need to spot it, understand the mechanics, and act faster than your morning coffee kicks in. Why? Because the last 3 times it appeared during this annoying margin hike saga, silver dropped between 6 and 9% by Monday's close. At 84.40, that's a slip down to somewhere around 76.80 to 79.30, which for 100 ounces translates to a loss between $510 and $760. Not exactly pocket change. Here's the kicker. This pattern is a 3-part disaster that only counts if all 3 components happen together within that early trading window. 1 or 2 pieces? Probably just Sunday night's usual drama that usually heals by Monday. But all 3? Historically, 0 rebounds by Monday close, every single time ending in fresh misery. First, you get a volume spike that would make a nightclub jealous, like 3 to 5 times the usual Sunday night volume. Price plunges between 80 cents and $1.50 below Friday's close, but here's the twist. No buyers. Normally bargain hunters or Asian market participants jump in within 15 minutes. This time, crickets. The order book looks as inviting as a Monday morning meeting, with barely any bids standing firm. If you see silver drop over $1 on huge volume and no bounce for 5 minutes, component 1 is live. Then comes component 2, the stop-loss detonation. Silver's chart currently shows cluster bonds at 83.50, 82, and 80. In a normal dip, price might tap 83.50, pause, then bounce back. Not tonight. In a cascade, these stops trigger one after another with no consolation break in between, pushing the price down like a relentless bulldozer. If silver breaks below 83.50 and then below 82 in less than 15 minutes without a decent pause, you're watching component 2's fireworks. Finally, component 3, margin call fallout. Thanks to a 68% margin hike pushing maintenance margin from 14,000 to 23,000 per contract, many traders are running on thin margins. A drop from 84.40 to 82 means a $12,000 loss per contract. If someone's holding one contract with 30,000 equity, that equity plunges to 18,000, below the 23,000 required. Brokers kick in auto liquidation orders, flooding the market with forced selling and pushing prices even lower. If silver breaks below 80 and volume spikes again, that's the margin call stampede in full effect. And nope, this isn't random chaos. All the right troublemakers are lined up. Fewer players, open interest down 25,000 contracts in 3 weeks, sky-high margin requirements, technical stop-loss clusters, options expiration letting prices loose, and the looming March delivery notice stirring sellers who want out. Think of it as a perfect storm brewing in a thin market. But here's the usual caveat. Just because the stage is set doesn't mean the curtain rises. The initial spark, big coordinated selling at the open, is unpredictable. Sometimes it's a giant institutional sale, sometimes an algorithm doing its usual Sunday work, sometimes nada. Historically, over 14 months, this nightmare only popped up 8 times out of 58 Sunday nights. What should you do if the pattern shows up? Don't lose your mind and sell everything, but do act practically. If the volume spikes and the first signs hit, consider trimming positions or adding margin to avoid forced liquidation. For ETF holders, prepare for gaps and potential premium compression. For physical holders, breathe easy. Your metal isn't going anywhere just because the paper market is throwing a tantrum at 6 p.m. Sunday. If the pattern doesn't appear, if volume stays low, dips are small, and prices bounce quickly, you're probably safe to sit tight and sip your coffee. Even a higher open would suggest the physical demand is fighting back, which would be noteworthy. In the end, this isn't a doomsday warning. It's a lesson on recognizing patterns, separating emotion from fact, and managing your position like you didn't just guess wrong. Because you can be absolutely right on silver's long-term trajectory and still get wiped out by a surprise paper market meltdown if you're not prepared. Know your positions, know your margin cushions, have a plan. And if the cascade hits, don't panic sell, cut risk smartly. If the disaster doesn't come, that's not wasted effort, that's survival skills paying off. Trust the data, not the drama.